It is my honor tonight to bring to you for presentation of our asset investments, Mr. Sean Gannon. Those of you that have been on the dais in previous years might recall that Stephen Alexander has done this presentation. Well, Stephen has retired, and we are in very capable hands with Sean, and I understand he's got some pretty positive news for us tonight. So if you allow me to welcome to the podium, Sean Gannon from PFM Asset Management.
Thank you. I wasn't expecting applause,
Yeah.
but
And if you would just
I'll take it where I can get it. Right?
your name and business address for the record, please.
Sure. My name is Sean Gannon. I'm a senior managing consultant with PFM Asset Management. So I have up here a couple slides for us to look at, and generally the agenda is going to be to look at the overall market, talk about macroeconomic factors that impact everybody here, and more specifically about your portfolio, and then take a look at how your portfolio performed over the past year. So, do you have a clicker? Yeah. Yeah, so about 16 slides here, but I'm not going to go through each one of them. I'll kind of, give you a brief overview on some, go deep dive into others. But generally, this first slide here is a good picture of, if you wanted to take this home for a nice read, gives you a little rundown of what's happened and kind of the larger three factors impacting your portfolio. The first one being, general economic update. Second one being specifically about the Fed, the Federal Reserve, what they're doing, why they're doing it. And then the third being interest rates and how they impact you. Briefly on this slide, this is our employment slide. Sum it up, and the employment market is fantastic, right? It is doing great. There are January unemployment rate was down to 3.4%, had 517,000 new jobs added in January, around 300,000 added in February. So really strong numbers here. But on the flip side, inflation has not been giving us the same story, right? Inflation has been the hot button topic. The Fed has come out and said, we're going to do whatever we have to do to bring inflation in check, and that has had major negative implications for most investors and most folks in our economy when inflation is kind of ramped up and continues to stay ramped up. So it's kind of hard to see on the graph here, but I'm going to kind of break out two and two of the different colors. So if you look at the top, that's energy. All right, so energy can be anything from natural gas to oil to renewables, et cetera. That's basically come back to pre-COVID levels. So the growth rates of the cost of energy, the cost of a barrel of oil, have come back into check. And I saw an article that Saudi Aramco had $162 billion profit this past year. So take that as you will. I think part of the high oil growth and the cost of a gallon of gas was due to corporate profits as opposed to supply chain issues. Those have been reined in now, so the cost of a gallon of gas is the kind of most close to the heart that you'll experience here for the average consumer. Also, the red, which is kind of buried in the middle there, so the red is goods but excludes food and energy. So that has also come down. So goods being anything from a t-shirt to a refrigerator when you take out food and energy. Now, looking at food, that has not had the same trend. Food has remained elevated. The cost of an egg is kind of the popular example right now. So the cost of an egg has remained very elevated, very expensive, and it's been hitting the consumers where it hurts, right? So that's generally across all products that somebody would buy at a grocery store. The same thing with services excluding. So the bottom set of data, excluding food and energy. That's kind of everything else. Everything you can't just click buy on Amazon would be the services sector. The most egregious part of that is housing. Housing has maintained a very high level of inflation, and the unfortunate thing is that housing takes a lot longer to retrace. If you think of how frequently rents can change, rents can have risen significantly, how quickly can they start to drop? Everybody's in 1 year, 2 year, 3 year even type of contracts. So as those rental rates come down, it will take longer to realize. And the impact that has is with the Federal Reserve. Look at the graph here on the bottom left. The Federal Reserve has said that they are going to think about pausing their interest rate hikes. So they raised interest rates February 22nd or March 22nd. They came out and said we're going to do another quarter basis point rate hike. The expectation was that they were going to do that, so they did what everybody thought. But as you can see, that trend line is moving downward. So the expectation now is that interest rates have hit their peak. They'll begin to retrace a little bit, and they will now begin to cut even at the end of this year. Now, the Fed hasn't said that. The Fed hasn't said that they'll begin to cut, but what investors and market participants think is that we will begin to see a bit of a retrace by this year. Now, the Federal Reserve says that they're waiting for inflation. We'll need to see some positive movement or positive sentimental movement, not negative percentage-wise, of inflation readings here going forward to get that actually realized. That's kind of it on the market. I don't have any slides. I know there's been a lot about the banking sector. This is an annual report as of December 31st. So before I'm going to address that, but I wanted to give a chance to ask questions about any economic indicators before talking about banks.
Good.
Good?
I think we're okay.
All right, great. So the good news is you don't hold any of the names that have been in the news, right? The Silicon Valley Bank, the Signature Bank, the Credit Suisse, none of them have directly impacted the city of Winter Springs in this portfolio, right? The poor management of and the market impacts that have caused these banks to go under and suffer severe losses were impacted by everybody felt it, right? It was a major story. It was a major factor when it comes to not only bonds, which is a portfolio of bonds, but also on the stock market. On the flip side, so on pension, there was a negative impactor. But generally, there was no direct impact to your portfolio, which has good. Banks like Silicon Valley Bank were single A rated, so they're investment grade. But as your investment advisor, we do our own research. We don't just take what S&P says at face value and then buy the bond because it's an A rating. We look at that kind of stuff and say, hey, they don't have enough diversity of depositors. They have too high of a percentage of uninsured deposits. So we're going to leave them alone for a little bit and buy something else. That has been kind of the story here. Most of this has not impacted us at all, but it's going to cause ripples throughout our economy. You don't have any questions about banks? Look at your portfolio. All right, good. I must be doing a really good job then.
Yeah. Happy that we didn't have money invested in those banks.
Yes, yeah, absolutely. So this is a snapshot of your portfolio as of calendar year end. So as of December 31st, you can see, I'm going to point to the top right here. That is your sector allocation. So the largest portion of that being in U.S. Treasury securities. And the reason I want to point that out is because when building a portfolio, we want to make sure that we have a good foundation, taking into account our state mandated safety first, then liquidity, and then yield after that. So we want to make sure that there is enough safety of principal in this portfolio that we won't be impacted by any negative market moves. The additional benefit is that if there is a recession, if the Fed keeps on marching on, keeps raising rates, pushes the financial sector into more turmoil, and that ripples out through the rest of our economy, everybody wants treasuries. Everybody wants investment-grade bonds. So when COVID hit, treasuries were the best performing asset out of anything across the board. They're better than stocks, better than real estate, better than cash. So treasuries are the golden goose when there is market turmoil. Now, if you're a bear and you think that there will be market turmoil here in the near future, this portfolio is positioned very well to handle that. Now, looking at performance, again, this is a portfolio of bonds. So the way that bonds act when there are rising interest rates is they have a negative mark-to-market effect. So there's an inverse relationship between yields rising and bond prices falling. As a holder of bonds, what that does is generate an unrealized loss in the portfolio. So if you look at the 1-year number, there is a $1.2 million unrealized loss. Now that is on paper. If you were forced to sell this entire portfolio right now, that would become a realized loss, but that, as we know, that's not really going to happen. So what will happen over the course of time is as interest rates kind of steady out, and they have been, right? You've seen the past quarter, we had a positive return, right? So a positive number, looking good, investing in higher yielding bonds. But this portfolio would begin to kind of drift into maturity, and as reinvestments occur, that number will decline. It's just kind of an ugly number right now, but as the Fed either continues their pace or decides to cut rates, that number will begin to get closer to zero and then even positive. So the pluses and minuses of a rising interest rate environment, that's the minus, right? There's a big negative unrealized number. The positives is that you're buying bonds at a 5% yield, a 4.5% yield. So really attractive when it comes to future earnings. So it's painful to get there, but once we're there, it's awesome, right? A year and a half ago, a bond would have been, a Treasury security, 3-year Treasury at 0.3%, almost zero earnings, right? So now the fact that we're able to kind of generate income and create, positive cash flows for the city, it is very helpful. I know negative returns are a hot button topic, so if you guys have any questions, please feel free to interrupt me. Now, this is a sector allocation, also say you're in compliance with your investment policy. So not a whole lot to touch on here. You can see well diversified across various sectors and all within compliance. And this is that issuer list. I'm not going to speak to this. All I have to say is that you will not find Credit Suisse or Signature Valley or Signature Bank or Silicon Valley Bank in there, well diversified across the sector. But this is my favorite graph. So the good news graph, it shows income generated over the past various time frames, 3 months all the way out to 10 years. So if we look at the past quarter, as the quarter ended December 31st, about $422,000 in positive cash flow generated. Again, this is on an amortized cost basis, not a market value basis. So we don't take into account the unrealized loss in here. This is kind of a more stable figure to look at. It's a more stable way to account for the value of a bond. $422,000 over the past quarter, about $750,000 generated over the past year. And then looking a little further out 10 years, portfolios generated about, $5.9 million in positive cash flows over the past 10 years. So averaging about $500 a year over the past 10 years. And with that is all I have. That's my last slide. Do you all have any questions about portfolio, about what we're thinking about?
I'll start off. If you go back one, and we're talking, can you remind, or one more, sorry.
Yeah.
One more. The benchmark.
Yes.
The 1-year benchmark. Can you remind me of the definitions and specifically where those numbers come from, the actual benchmark?
Yeah.
It's just a nationwide average number. Just want
It's
to make sure. So we're outperforming the benchmark.
Yeah. So we decide on the benchmark based off of a risk return profile, how comfortable, how much risk are you willing to take for the return. So the benchmark for this portfolio is it's got a long name because it was bought out by a couple times. The Bank of America ICE Intercontinental Exchange 1-year Treasury Index. So it is a benchmark of 1-year Treasuries. That's it. It's not a peer comparison. It's not a secret benchmark. You could Google it, find it right now if you'd like. So it's very common industry standard local government investment benchmark. Yeah.
So it's appropriate to interpret whether it be the 3-month, the 1 year, 3, 5, or 10 years. Our portfolio has outperformed the benchmark in every single one of those categories.
Yes, that is accurate.
Thank you.
Sure.
Commissioners?
So I would imagine you do have some interaction with the Winter Springs Board of Trustees?
For the pension? No.
Yeah.
You do not?
That is a different advisor.
Okay.
Yeah.
And so the fact that we're in the state of Florida, where the economy seems to be doing better than other states, does that have any effect on what we're seeing here?
Yes. So if we kind of think about cash versus investments. So we think of kind of two buckets, if you will, liquidity reserve and a core portfolio. This would be the core portfolio, right? It's invested, it's actively managed by us. And then you kind of have your cash, which is going to be, accounts payable, payroll, your payment into pension, into your OPEB, et cetera. That's a separate bucket. So if you were in the Rust Belt and a declining population and people moving out where you were having cash flow issues, yeah, we would have to be more probably shorter duration, where it's more liquid, where there isn't really an unrealized loss position generated, and more focused on keeping liquidity available for this type of portfolio. Whereas you all who are growing and dollars are being added to the portfolio as we look at that and see higher cash balances, we're able to invest more frequently, if that makes sense. So every couple of years, we take a look and say, hey, and we'll work with staff and say, hey, you have $1 million extra that wasn't spent this year that you weren't expecting. Let's add it to the portfolio to increase kind of that core and that income generation machine that is the core portfolio.
And so that because of that those additional funds that you just mentioned, that doesn't cause us to take on more risk. It just allows us to invest the way we've been. It's just more.
So there's like a lot of different types of risk, right? So cash has what's called inflation risk. If you keep too much cash, the inflation erodes the purchasing power of those assets. This would have a higher interest rate risk, right? It'd be more susceptible to changes in interest rates because it has a longer duration. It would have higher default risk than cash at the bank because you're buying corporate notes and commercial paper. So you're kind of trading cash, or you're trading risk, if you will. But in the same breath, you're also increasing your return. So for every amount of additional risk you take on, you have to be compensated for a return. And that's the case today. Yeah. Does that answer your question?
Yes. Good. Thank you.
Sure.
Other questions? Yes, Commissioner Colangelo.
Yes.
Oh, I'm sorry, your button was
Oh.
accident. I went off by
No,
accident.
good.
Oh, okay, Commissioner Resnick.
So, Commissioner, as we're looking at it, even though we're talking about risk and reward, the growth is less than 1.5%. So as we take a look at the value of what we put in there, our risk reward is very minimal. So when we're talking about risk, we're not looking at a growth perspective of 5 or 10 or 15% or a loss of 5, 10 or 15%. So we're really conservative in where we're going.
Yeah.
And I think it's set up a long time ago to be this way, right?
Yeah, exactly. As far as kind of the spectrum of risk return profiles, you guys are closer to the conservative end of that. Yeah,
Almost
absolutely.
extremely conservative.
Yeah.
Oh, Sean,
Yes.
PFM Asset Management, how many, if you were to guesstimate, or can you give us some insight on other municipalities, number of municipalities where you manage their portfolios? How many?
Yes.
How active are you guys?
We are the biggest in our space, right? So we are a 100% institutional asset manager. 99.5 of them are local governments. We manage money for 3 different community banks, so that's why I have to give the 99.5. But about 202 billion in assets across the United States. So we are a very large player. So if you have questions about what everybody else is doing, I'm happy to answer it.
That's right where I'm going. So municipalities of our size, 40,000 residents, maybe regionally specific if you need be. How would you say that we are performing, say, on returns? We'll start with that. Are we, on our returns, are they acceptable and average for our size? Do we outperform? Do we underperform?
Yeah, so I would say you are about average. There are entities who don't invest at all. And then you have folks who, in Florida, the investment statutes are very broad. there is a line item in 218-415, which governs investments for operating funds, that says if it is board approved, you could do whatever you want. As long as it's not negotiable CDs, you're allowed to do whatever you want. So you could buy stocks if you wanted. You could buy real estate with this if you wanted. So we do have clients who are larger, and they say, I want to put 5% of my portfolio in like the pension fund, a 60-40 type of multi-asset class stocks, longer duration bonds, stuff like that. So it is a broad spectrum in terms of performance. They're probably performing better because of that equity sleeve, but it is much more risky. Yeah, there are far more negative quarters. When the negative quarters come, they're more severe. So I would say that you guys are performing well for the size of city you are. You're right there, performing how you're supposed to be.
And the size of our portfolio compared to other municipalities of our size?
Yeah.
How would you compare that? The same?
Yeah. So I would most closely associate you guys to Winter Garden, if that's correct or incorrect. And their portfolio is about $5 million larger.
And you would rate theirs healthy, and you would rate the city Winter Springs, if you had to choose a word,
Healthy.
healthy.
Yeah.
I didn't mean to put
Yeah.
one in your mouth.
Yours is more healthy than theirs, I think, because
healthy.
their investment policy they've had some turnover at the city manager position, and the previous city manager who was going to retire. Not to talk too much about a different city, but he said, I don't want to make any decisions till I have my replacement. So kind of put a hold on that. Your investment policy was better from the start. We've been working with you for a long time, and we're able to kind of position you there. So stuff like the corporate notes, the commercial paper, they can't do that right now, and those are extremely additive to performance. They're very well. They perform very well. They generate a lot of income, and they have relatively low risk. They have higher default risk, right, of a company going bankrupt as opposed to the United States government, but that hasn't happened. We don't expect it to happen. So. Through the credit research and all that, but you guys are in a really good, really healthy spot. Yeah.
Thank you. Any further questions? Thank you for your time.
Sure.
Appreciate you coming in.
Thank you for having me.
Thanks.